The mortgage market, as you know, is booming, declining rates pushing applications higher, which benefits buyers and lenders. The CEO of Quicken Loans telling CNBC that Quicken Loans has seen record loan volumes in the past few months. Since the Great Recession, companies like Quicken Loans have seen their share of the lending market grow. But many, including Jerome Powell and JP Morgan CEO Jamie Dimon, argue they need to be watched more carefully. Joining us now to discuss this is Chris Brummer, the professor at the Georgetown University Law Center. Chris, great to have you with us here. You see that this could potentially be a risk when the economy turns. Can you walk us through the steps as to why a non-bank mortgage loan could present problems?
Well, it's a little bit like, do you want to put Katie out on the basketball court against the Raptors, right? Right now, you have the opportunity where you have these loans. They've suffered different kinds of catastrophic injury back in 2008, but they have this shot of adrenaline called low interest rates, called a strong economy. Certainly low taxes probably have helped. But again, when the pressure is applied to those legs of these instruments, well, are they going to end up blowing out their Achilles? And that's really the question that's being asked, that when the economy starts to decelerate, are you going to have a challenge posed to these financial lenders, these non-bank lenders who are subject to fewer capital constraints? And are they going to ultimately be able to withstand that economic pressure?
So
and will taxpayers
I think that to understand this issue, Chris, we have to focus in on the last part of what you said, and that has to do with the regulations. For non-bank to extend a mortgage, they're subject to fewer regulations or lighter regulation than, say, a JP Morgan or a Wells Fargo or any of the traditional banks. Is that what you're saying?
That's right. That ultimately these banks are subject to fewer capital requirements, fewer liquidity requirements, and your traditional banks are also subject to much more rigorous stress testing, which can also ultimately impact the amount of capital that they have to hold.
Diana, you're shaking your head.
Yeah, I'm shaking my head because, look, you're talking about the capital requirements, and that may be true for the non-bank lenders. But remember, let's focus in on the loans. The loans they are making, the non-bank lenders, are largely backed by Fannie, Freddie, FHA. Therefore, they have to follow all of the guidelines as Fannie, Freddie, and FHA do for all the other banks. They are not any more risky loans. The vast majority of these loans are 30-year fixed, and they currently have the lowest delinquency rates than we've seen in years. So, yes, if there's a turn in the economy, that could hurt some borrowers, but it's not like these loans are any more risky than the loans that are being offered by the big banks or were offered. You know, I think everyone says this is the shadow banking system. There is nothing nefarious about a non-bank lender. They're simply not these depository institutions, but they're getting a lot of business, and they still act the way they do for Fannie Freddie guidelines.
Chris, respond and address the question of what happens with these loans. Aren't they sold pretty promptly by these non-bank lenders?
Well, exactly.
So they're not on their books.
Exactly. So, well, two things happen. Number one, they're sold and they're not on their books, but often they can also operate as mortgage servicers. And that has a real impact if they're wiped out in the ability to service those loans if there are defaults. But also they're landing on the balance sheet of institutions that are ultimately backstopped by the federal government. And we've always been very wary of that, and we've seen this story before. What happens when the government and ultimately taxpayers have to pay the bill for loans that are ultimately being subsidized by these, in this particular case, explicit government guarantees.
All right, we're going to have to leave it there.
But isn't that the same for the banks as the non-banks? Yeah.
No, actually, it's not actually true that the loans that are extended via the, particularly as pertaining to your FHA loans that are ultimately purchased by the Freddie Mae and Fannie Mae are of the same, that the same rules are necessarily going to be able to apply because they can assume and purchase debt that has a higher debt-to-income ratio, as would ordinarily be the case for other ultimate purchasers of those loans. And the non-banks are able to arbitrage some of these rules and are able to escape the capital requirements while at the same time enjoying a kind of subsidy by offloading those loans onto these government-backed entities. And that's the problem, and that's why there are red flags being raised.
All right, we're going to leave it there. Thank you so much, Chris Brummer and Diana Olick.
All right, thank you.